Nvidia is extending its losses after suffering the largest ever one-day market capitalization drop yesterday. Adding on to recent pressures, the U.S. Justice Department investigation into the chip giant, the DOJ reportedly sending subpoenas to Nvidia in the escalating antitrust probe. So is it time to change the investing mindset in tech and in chips specifically? Here to discuss, Matt Stucky, Northwestern Mutual Wealth Management Chief Portfolio Manager. Matt, thanks for being here. How are you thinking about Nvidia and that tech trade right now?
Look, right now, I think we're in a period of market volatility. I think there's a lot of monetary cross currents going on, investors questioning the overall kind of health of the economy and kind of what growth risks are building right now. And let's face it, Nvidia is not a defensive stock. And so, all of those factors to me equate out to a picture of continued volatility around something like Nvidia, which has a beta of 1.7. And so those moves are outsized as it relates to the individual name here.
So are there ways to play the AI trade, Matt, that you like that are less volatile?
Unfortunately, I don't think that there are ways to play it to get the specific AI representation that Nvidia represents here. Nvidia dominates the infrastructure layer of AI today, and that's the action that's playing out in terms of investment so far. Eventually, that should transform into platformization, and eventually applications that continue to fuel the investment and ecosystem surrounding AI, but we're just not there yet. So if you want exposure to the best of the best as it relates to AI equities, Nvidia continues to dominate that trade. Now, I think you have to have a risk appetite that equates to what the ride in Nvidia is likely to be. Look, we've been investors in Nvidia since Q1 of 2019. And the backs and force in the name are very similar to other semiconductor positions that we've held in our portfolio over that period of time. You have to have a risk appetite that matches the ongoing volatility of the stocks that you own, and NVIDIA is one of those that's a higher risk name.
Let's broaden it out to the rest of tech a little bit here. Are you also sort of looking, as you said, NVIDIA is the one that's sort of viewed as best in class in AI specifically right now, but are you also sticking with, for those with a high risk appetite, some of the other large cap techs as well?
I think collectively, if you look at some of the largest technology names that are out there, those have really been carrying the water so far this year in the S&P 500 from a fundamental perspective and from a return perspective. And so if you look at just what the market expects the S&P 500 to earn this year, it's roughly been about flat throughout the year, just in terms of what the earnings level should be. But if you take out the top 6 names of the S&P 500, that number would be about 8% lower. Another way to put it is if you only invested in the top 6 names, the earnings expectations where we sit today for the calendar year of 2024 are 30% higher. And so there's a good fundamental story there. The problem you run into is the ongoing kind of valuation concerns that are starting to bubble up. Are these names just simply getting too expensive relative to the rest of the market? And I think that's where we need to have some debate around whether or not the ongoing feasibility of the valuation support is going to continue to be there if the growth outlook were to roll over for the U.S. economy.
Matt, we've talked today a lot, including with another strategist, about whether growth concerns are bubbling up. Given what we see with manufacturing activity, jolts, just now with the Fed's beige book, interested to get your perspective on that.
With so much talk about what the labor market is doing, I think I would just remind your viewers that focusing on the labor market is a good thing to do that, but let's just not forget that that's a lagging indicator of the health of the economy. And so weaknesses that are bubbling up in the labor markets are probably telling us that the leading indicators of the economy are continuing to compress further down into contraction territory. And if you look at the Conference Board leading economic indicators as a reference point for that, we're in a drawdown territory that we've only been in 4 other times in U.S. economic history post World War II. So there are some areas that we would say let's be a little bit cautious here as it relates to the forward outlook on the macro, and the labor market is again a lagging indicator, and it's finally starting to slow down quite a bit.